This video is going to discuss the expenses section of the income statement. And as you begin to understand how this income statement is structured, you'll begin to see it's really quite logical. But you got to be very, very careful of it. You understand where all the values come from in the chart of accounts. In an expense section, it's actually broken into two categories, so be careful here. One category is operating expenses, and operating expenses actually start with this purchase feed and goes all the way down through depreciation. And this segment is referred to as operating expenses. And you'll notice that can be a little bit confusing because we have the word cash operating expenses, we have accrual adjustments, we have these little items up here for purchase feed and then depreciation. But all of these things in that blue box are referred to as operating expenses. The other section of expenses is actually interest paid on the farm. And interest paid on the farm is a separate category of expenses than the operating expenses. In other words, interest is not considered an operating expense. And the reason being is because if you're trying to compare your farm from a management standpoint from one year to the next, or if you were trying to compare your farm to other benchmark type farms, different farms have different amounts of borrowed money. So if you include that interest, sometimes you get a sort of a bias there in terms of the amount of expenses simply because there's different levels of credit. And so Farm Financial Standards simply says, let's keep interest separate, and we will actually calculate profits sometimes with and without that interest. And then that number is a little easier to make comparisons. Just as in the revenue section, all the expense items that go into the sales simply come from somewhere in the chart of accounts. Farm Financial Standards suggest that you keep purchase feed and purchase market livestock in a separate little category. And the reason they do that is because if you're buying livestock for resale, it's a little different than raising that livestock for resale. We'll talk more about that actually when we talk about income tax, but that's just a way to keep a little bit separate accounting for livestock that is like you purchase a steers at 400 pounds and then you want to keep them until they weigh 800 pounds and resell them. That's a little bit different than raising that steer on the ranch and then selling it. So anyway, purchase feed and purchase market livestock is usually kept in a separate category, even though they are still operating expenses and they still represent maybe a cash expense. They're just listed separately so that you can pull those numbers out later and use them in some of the analysis. All of these items, starting with purchase feed all the way down through the cash operating expenses, this group right here, simply come from your expense ledger. In other words, you remember the expense ledger when we did that in the chart of accounts, where you would simply go in and have every expense would be listed, and then it would be simply categorized by whether it was seed, fertilizer, chemicals, and so forth. At the end of the year, you would have a column total for seed, you'd have a column total for fertilizer, for chemicals, for insurance, for marketing, and so forth. And those numbers at the end of the year in that expense ledger is what would go right here. So all of these numbers that are right here in this group simply come from your expense ledger. So if you were building this in Excel, you would simply put a link there. There's no actual typing in to the income statement. Everything comes from the chart of accounts. See, the chart of accounts is your detail in your record keeping system, and your balance sheet and your income statement are simply your summaries. Okay, let's get down here to the accrual adjustments. So where do these numbers come from in these accrual adjustments? In accrual adjustments, which would be these cells, I actually carried that bracket down a little too far. The accrual adjustments right here in these cells are where you would actually pull information from those different accounts. So the information for accounts payable, prepaid expenses, and other accrued expenses are actually come from the chart of accounts for each one of those items. Now, the other accrued expenses could be many different things. You know, we talked about that earlier in the chart of accounts. That could be rents, that could be property taxes, that could be accrued insurance. There's lots of things that could actually go in that category. So let's take a look here now at accounts payable. When you go back and look at the accounts payable in the chart of accounts, if you'll remember, we simply set it up where we had some different uh, accounts that had to be payable each year. In other words, these were open accounts at the end of the year. So, for example, we at the end of the year we owed the co-op this much, the lumber yard, the diesel distributor. At the end of the next year, we owed the, somebody else, but we had some open accounts. Now, at the end of the first year, we owed in open accounts $4,800. At the end of the second year, we had owed open accounts of $10,200. Now, these two numbers right here, those are not income statement numbers. Those are something you owed. So those were liabilities. And those liabilities simply went on the balance sheet, if you remember. But the change from one year to the next, okay, that was where those accounts actually changed in value. And now that change in value is something that you've bought extra during that year you hadn't paid for yet, so it should be an expense. So that change in the accounts receivable is what goes on that income statement. So you would, again, you would calculate all the things that you owe in terms of an accounts payable at December 31st of one year, and then you'd account for all the accounts open December 31st of the next year, and that information would simply go right there at accounts payable. Exactly the same thing for prepaid expenses. If you go back and look, we had a prepaid expense illustration where we had things that we had bought at the farm at the end of the year but hadn't used yet. And you did a little exercise where you did these totals. Well, the totals right here is balance sheet entries. But the change in those totals was prepaid expenses, and that number would actually transfer over to the income statement. So the prepaid expense account right here would simply come from the chart of accounts for prepaid expenses, and it would be the change. So you need to remember now, all through this income statement, whether we're dealing with revenue or whether we're dealing with expenses, when you get to the accrual adjustments, what you're dealing with in those accrual adjustments is change, not the actual value. The change is what's important because that change represents something that took place during the year, and that's what the income statement is illustrating, transactions that took place during the year. Okay, let's move down to the expense account. Remember, expense is not an operating expense. Interest expense is not an operating. When you get down to the interest account, you've got two items. You've got the cash interest paid and the change in interest payable. Now, what that change in interest payable is the change in accrued interest. So this right here is actually the change in accrued interest. In order to get this information, you must go to the amortization schedule of all the different loans on the farm. So remember, an amortization schedule looked like this. And you would have one of these for every single term loan on the farm. So if you were at this income statement, let's just say this income statement for a moment was 2015. So where it says cash interest paid, I'll move this over a little so we can show you. Where it says cash interest paid right here, this item, for 2015, there's the cash interest paid right there. That number would simply go to this slot right there. All right. The change in accrued interest, that's that change in accrued interest. That's that 557 right there. So that number, that change in accrued interest for 2015 would go right here in the change of accrued interest segment right there. Now, again, remember, if you had three different loans, one for machinery, maybe one for land, one for breeding stock, then you'd have to sum the interest for each of those for that year, and you would have to sum the change in accrued interest. But those are where the two items go for the income statement. They simply come from the chart of accounts. Once you get the interest total, in other words, the total interest is simply the cash interest plus the change. When you get the total interest, then your total expenses right here, this total expenses is simply equal, whoops, excuse me, it is equal to total, I can't type, total operating expenses plus total interest. So total expenses now is a sum of the two categories. In the blue box is operating expenses, in the whatever color that is box, that is the interest expense, and total expense is simply those two added together.